So today we're going to talk about a 2023 correction, not necessarily a crash, as indicated in my video last Friday. For this video, I'm going to focus on supply and demand because a lot of people are talking about real estate. It's undersupplied, it's undersupplied, it's undersupplied, and it is. But I believe not a lot of people are focusing on the demand side, and that actually is what's going to create this correction. So when the Fed reduced their federal funds rate to almost zero in early 2020, it created a rush of people buying homes, which created a supply issue. It brought supply down and drove prices up. This created an affordability issue for many Americans. And now, of course, we're starting to see the Federal Reserve raise rates again, which is creating an affordability problem even more. We have high prices and high interest rates, and it's driving most people back into rentals. So when there's more homes on the market, prices go down. When there's less homes on the market, prices go up. And the mechanism that was used by the Federal Reserve was interest rates. First, they went down in 2000, and now they're going back up, which is creating some demand shifts and supply shifts in the market. So here's a simplistic view of what's going on right now. In 2021, demand was very high for housing, which created the prices to go up. The supply is down, and it is still down, and we'll talk about that in a minute, and interest rates were also down. So this is what drove prices up in 2020, 2021, and in early 2022. The big shift is interest rates have gone up significantly, which has lowered the demand, which is now starting to increase the inventory and starting to tamper prices around the country in many, many markets. It's interesting to note, and a lot of you are going to focus on supply, that we are still very undersupplied. And I agree with you. However, we have an affordability issue, and we have a significant drop in the demand due to the price of money. So while many of you are focusing on the supply side, perhaps you should also focus on the demand side. There are a number of factors that go into this. Of course, there's population growth, there's job growth, there's permits, there's existing housing shortages, there's cost of labor, cost of construction, cost of land. All of those things have to do with the individual real estate markets. And your area is very unique to itself. So the market conditions in Cleveland, Ohio are going to be very different than those in Phoenix or those in Miami, as an example. So now let's take a look at the St. Louis Fed's chart, the monthly supply of new houses in the United States. I think this is important. It's not the total inventory, but it's the monthly supply of new houses. Most notable is in March of 2021, when the Federal Reserve first raised rates, you can see that the chart started to go up from the very first federal funds increase by the Federal Reserve. The chart is July of 2022. This is after 4 rate increases. As you can see from where we were to where we are, this is a significant difference. And the only thing that changed was that the Federal Reserve increased their rates 4 times during this period of time, and interest rates almost doubled. Keep in mind, guys, this is supply, not necessarily monthly inventory. But what I want you to see is the gap here. This is one of the biggest increases since 2009. It's significant, and it needs to be watched. Now let's take a look at what's happened from these interest rate increases. Mortgage demand has dropped to a 22-year low. If that isn't a red flag, it should be for you. In addition to that, mortgage applications are down 23%. And by the way, guys, that's a big number when you're talking about millions and millions of people. But what's most notable is the bottom one, and this is really important. Mortgage applications to refinance a home fell another 1%, but we're 83% lower than the same week 1 year ago. So new homes are down 23%, and cash out refis are down 83%. This is significant because this bottom one was the ATM movement that everyone was using to fund the economy moving forward. This is where they were getting all the cash, and as you can see, that window is closing. So what's happening here is people have a wealth trap in their own homes. So they're going to watch the prices of their homes go down and their wealth go down over time because they're not going to want to refinance because prices for interest rates have doubled. They're going to want to hold on to the old interest rates because if they do a cash out refi, their mortgage payment could significantly go up. So now let's take a look at a couple charts, and I think this one over here by the National Association of Realtors is really important. The red is a high housing shortage, and the blue is sufficient supply, which means there's not too much and not too little. And then the gray is no job creation. This chart could be the precursor to where prices are going to fall as a result of all this. Because again, going back to how we started with supply and demand, if demand reduces, supply increases, prices will continue to go down. But in markets where there's already a shortage of supply, you will not see quite the price decline. So let's take a look at this chart. The Fannie Mae forecasts themselves are showing a significant reduction in home price growth. Now, they're still actually showing home price growth, but I think that's because they have to. But really, if you look at what I'm going to talk about next, I think a lot of people are showing that we could potentially get into negative territory here. So again, are we in a correction? Are we in a crash? And the difference is 20%. So a correction is under 20% and a crash is over 20%. So the last crash we had was 27%, where home prices went down that much, and that was considered a crash. There's a couple great articles that I would encourage you guys to look at. This Ivy Zellman, who predicted the real estate crash in the mid-2000s, and she's basically saying that we are going to get into negative territory. I think she said there's going to be between an 8 and a 9% price reduction in each of the next 2 years. But guess what? Ivy Zellman is not the only one predicting these negative price reductions. Many research firms, including John Burns, Zonda, Capital Economics, Pantheon, Fitch Ratings, even Moody's are saying that we're going to go into negative territory. And here's the most alarming article at Fortune that you need to look at, is that Zandy believes that we're going to have a 15 to 20% drop in the nation's 187 significantly overvalued regional housing markets. That's shocking. Now, it's possible that they're not wrong, but if you take a look, going back to the basics, we're at 8.5% inflation. The Federal Reserve's got a 6% issue, and the target's 2%. And mortgage applications are at a 22-year low, and we're 23% off. The new one's 83% off the refis, which means a significant slowdown in real estate, which means a significant price reduction, and inventory will go up, and demand will go down, and prices will also come down.